The U.S. economy is facing a challenging environment riddled with worries over inflation, large deficits, and monetary policy pressures. So how do Americans feel about the economy right now? Well, we took to the streets of New York to find out.
My biggest financial concern right now, probably staying afloat, like paying rent and other expenses and food, just trying to get by.
Everything is more expensive than it used to be. Rent prices in New York are going crazy. The job market is looking really tough right now. I know a lot of new grads who are having a really hard time getting jobs. I think that's a good sign of the economy going down.
Everyone is confused about the tariffs changing, not knowing what the price of their goods are going to be.
We just heard their thoughts from the everyday consumer on the economy in a year that has been weighed down by uncertainty, yet the bull market entering its fourth year despite lingering risks. We've got a lot to unpack here at Invest as traders aim to build even more wealth next year. So let's dive right into what's shaping the financial landscape with ADP Chief Economist Nela Richardson, Truist Chief Investment Officer and Chief Market Strategist Keith Lerner, and last but not least, People Inc. Chief Business Editor, that would be Caleb Silver. Welcome to you all. Nela, I will start with you as the resident economist on the panel. Maybe start big picture, Nela. You know, this interesting dynamic this year where, okay, cooling labor market, but GDP has been hanging in there, right? I mean, tariffs, trade, Fed uncertainty, it's hanging in there, it's resilient. And I'm just curious to get your take on that dynamic, Nela, and whether you believe that's going to play out the same way in 2026.
Yeah, so the labor market has really been holding hands with the consumer this year, and actually for the last several years after the pandemic recovery. We have a relatively strong labor market. It's been called low hire, no fire. I think it's been static. It's been less dynamic than we're used to, but we haven't seen a lot of outflows or inflows. What we have seen, though, is that the hiring momentum has slowed quite a bit since the beginning of the year. So yes, the consumer is still well supported by a functional labor market. That means they're going to keep spending, but you can already see from the tape you rolled, there's an uncertainty cloud over that spending. And that uncertainty is strongest for low-income, low-wage consumers. So even though we have an economy and a consumer that is strong enough to keep that economy growing, it may not be strong enough to keep the job creation flowing and that hiring momentum. Yes, strong enough to spend, but not strong enough to get those mom and pop businesses to hire yet another worker when they're already facing a lot of uncertainty.
Keith, I want to bring you here as well. Your outlook for the economy next year, what do you see, Keith?
Well, a punchline is an uptick, and it's a modest uptick. As you just discussed, it is a two-speed economy. It's a two-speed stock market as well. But the way we're thinking about things and why we expect at least a modest uptick is based on three things. One, we do expect the Fed to cut rates modestly over the next year, so that should be a positive. We have this tax bill that was passed. We should see some incentives and some positives in the first quarter as far as for the consumer and also businesses. And then hopefully we'll also have a little bit more clarity on tariffs. So you put that all together, that suggests to us a modest uptick, maybe a little bit above 2% as we move into next year.
Caleb, I want to get you in as well, because you have a unique insight, Caleb, into the retail investor. When you're surveying all those fans over in Investopedia, how would you broadly characterize investor sentiment right now based on your survey work? I mean, is it optimistic, Caleb, cautious, downbeat? What do you see?
Yeah, cautiously optimistic is how I would describe it, and why not? We are seeing many all-time highs already so far this year. We do have the wind at our backs in terms of corporate profits, and we've been seeing that play out in the earnings numbers, but they're also concerned about the underlying economy. At what point does a potential weakness in the economy translate into weakness in the stock market? So far, they're still dancing in opposite directions, and that's kind of, they usually move in different directions or usually not down the same path. But right now they're wondering, is this going to last? And they're worried, just like some of the people you talk to, about their own personal finances or about their neighbors' personal finances. In the stock market, their assets have done very well. We got more millionaires than ever. We got more 401k millionaires than ever. We have more retail investors invested in the stock market than ever. That's good. That's a way to generate wealth. But maybe at some point, this diversion between the two, the economy and the stock market, catches up to the stock market and affects overall mood.
Nela, Keith brought up the Fed there. You say something interesting. You say the time for easy answers for the Fed is over. What did you mean by that, Nela? What makes this environment more tricky?
You know, I call it the muddled middle. It's easy to know what to do when inflation is very high. And it's easy to know what to do when there is very low inflation, or going back to where we were, you know, before the pandemic, when the problem the Fed was facing was too low inflation, not too high inflation. Imagine that.
Right.
But it's hard to know what to do when both sides of your mandate are active and you're trying to thread a needle through a very narrow hole. And that's exactly where the Fed is today. They have projections that inflation stays above their own targets for the next 2 years after being above target for the last 4 years. And consumers are very sensitive to price increases in a way that they weren't 10 years ago. So you add that with the slowing momentum, still a pretty solid labor market, but a slowdown in that hiring momentum, you get a very tight spot for the Fed to maneuver going forward.
I've seen some economists now, what is your take on this? They talk about the labor market. I think it was Ed Yardeni, and he said, you know, the issue with the labor market, he said, was on the supply side, boomers are retiring, they're not easy to replace, you got stricter immigration policies. On the demand side, he pinned a lot on AI. A lot of bosses, he thinks, are thinking, you know, I can reduce headcount but boost productivity. His point was, Dr. Ed, he doesn't see how a Fed cut addresses any of that. What do you think?
I think that is the key issue. There is a conflation of things that are short-term in the making in the business cycle and structural, whether it is AI exposure and impact, demographics, immigration, uncertainty. These are structural changes to the economy, and the Fed acts short-term. That's why at ADP we actually started producing just 2 weeks ago a weekly index of employment change. That way we hope that investors can have a real-time perspective of what's going on in hiring, because there is so many things happening all at once.
Keith, turning to that Fed meeting next month, it's interesting. Some of our central bankers, when you listen to them right now, it doesn't sound like that cut's a sure thing. Some of them seem to be saying, listen, that 2% target, it's a target. It's not a suggestion. I just wonder if next month you don't get the cut, how would the stock market react, do you think?
Well, right now the market is pricing in about a coin toss, and I think that's probably about right. And to your point, you know, they have scar tissue from the inflation before. They're in a tough position. So I think initially you could have a bit of a hit, and you probably would see that more in the small cap and more of the interest rate sensitive areas. But I also think that for this market, the most important thing isn't whether the Fed cuts in December or January. I really think it's about corporate profits. And you know what we've been saying all this year is that the North Star of this bull market is corporate profits. As the stock market has made a new high, corporate profits has followed. Now we have to see, is that sustainable? A lot of that is driven by tech and AI, but we have seen that broaden out as well. So I overall, again, I think the interest rates moving down matter on the margin, but it's not the make or break for the bull market. I think profits ultimately will be, and if we do see a little bit of an uptick or this muddle through that you just discussed continues into next year.
Caleb, when you survey folks about the Fed, I'm interested, what feedback do you get? Are they fans of Jay Powell? Are they critics?
You know, largely in support of how the Fed has handled monetary policy and want the Fed to remain independent. That is one overall sentiment that they think most of our readers who are individual investors have. They really want the Fed to remain independent. They think that's super important. But to the point that these guys have made, it's not really necessarily where the rate goes from here. The rate is the rate. I think it's about corporate profits. And when you think about how investors are perceiving the stock market right now, the most important metric probably is revenue per employee. And that is driven by AI and other advancements. But if you look at the best performing stocks in the market, they have the highest revenue per employee. Look at Nvidia, it's $3 million per employee for that company. And when you look on down the list, that's what's important. That's what's been driving the stock market and stock market returns. That's not a great sign for the labor market long term, if that's what we're going to be seeing going forward.
Keith, you know, every bull market has a theme. This one's been AI. Caleb, they're talking about Nvidia. I feel like I have to ask you, and it's a top of mind question for so many investors. I'm sure your clients are asking you, AI boom, AI bubble. What do you tell them?
Yeah, so you're right. Every bull market has a dominant theme. AI and tech is this market's bull market theme. The biggest question I'm getting is, are we in a bubble? And our answer is no. When we look at the data, at least that's what the data tells us. So what are we looking at? Well, there's a couple of factors, but one is valuations by themselves. Valuations are rich, but if you look at the S&P technology sector, We're trading around 30 times. That's expensive, but during the bubble, it was 50 times. Another statistic to take away the valuation component is just saying price. Like a bubble has a momentum aspect to it, especially towards the end of it. On a year-over-year basis, the technology sector is up about 30%. During the bubble period, it was up more than 100%. I also started my career in the mid-90s, and when people would call up and they wouldn't know the stock name, they would be saying IOM or JDUSU. Most of my questions today are we in a bubble? That wasn't a question back in the late 90s when people were leaving their job to be day traders all day. So it doesn't mean we can't have a correction. We had a big run. We're seeing a little bit of nervousness. But ultimately, I think that underlying trend for tech is still intact, but we're taking a breather. We're seeing some rotation, and there's just some concerns. But I do think money will ultimately come back to tech because that is where the secular growth is.
This AI boom bubble debate, though, Keith, there is an interesting question. I love your take on this, which is when you see this AI infrastructure build out.
Yeah.
I know some folks have been saying, well, if you're funding that with cash,
Yep.
that's one thing. But now if I'm watching companies tap debt markets to finance it, that's a yellow caution flag. I'm curious, do you agree with that?
I mean, on the margin, the story for tech was they were asset light and cash rich, so that story has changed. So on the margin, there's more risk as you take on more debt. So I think we have to take that into account. But we also have to think about, if you listen to the leaders of the industry, this infrastructure build is huge, and there has to be a lot of spending to do that. Going back to the 90s, one company that came out a lot, you probably remember this, is Amazon. Like every quarter, people were saying, how much are they spending? How much are they spending? And they weren't profitable. Well, ultimately, it worked out, and they needed to spend that money, but they went through some ups and downs. So I think that's that's what we're going through right now. We don't know exactly what the future is. We know that this AI, I think, is real, and the rate of change is so quick, so it's hard to get your arms around it. But ultimately, I think there are going to be a lot of great things. But when you have announcements or some concerns about debt, and you have higher valuations, investors, sell first and ask questions later. So I think you have to go with the ride. We saw that kind of bumpy ride even during the pre-bubble period. But ultimately, I think a lot of things are going to come out of this in a positive way for corporate profits and productivity that will boost these stocks.
Nela, you look through AI through a different kaleidoscope, right, as an economist. How quickly is AI impacting the labor market? Is it even faster, Nela, than maybe we would have anticipated?
It is having an impact,
Yeah.
but I think it's important to see the full context of the labor market. 3 in 4 U.S. workers work in a small company with less than 250 employment count. So while big companies are driving the headlines right now in terms of AI impact, it's smaller companies that actually produce the hiring. And so what we're waiting for, the stock market is a forward-looking discount mechanism. They're seeing ahead into the future. And what we're looking for in the real economy right here, right now, is that impact translating into the smaller businesses and to the worker. And where we're seeing the biggest impact right now is early career. And I'm sure you've heard all of the anecdotes. It's harder for college-age students to get jobs right now. There are some things that AI is taking over in terms of that entry-level role. But when you look at the kaleidoscope of tenures, it's actually likely to augment jobs as well. So that path to the future that the stock market is already seeing, in my view, will be jagged. It will depend on the industry. A lot of consumer-facing industries are where we're getting job gains right now, like healthcare, home health aides. Those kinds of jobs are still going to be very, very much in demand, even though they might be the last to get AI exposure and technical advancement. So it's going to waffle a little bit more in the real economy than what we're seeing in the stock market.
Caleb, how excited are those Investopedia readers and fans about AI?
Pretty excited, and when you look at their portfolio, it looks a lot like the top stocks in the stock market. That
What do they like?
Full of AI. They like the stocks that everybody likes, which is Nvidia, which is Palantir, which is Meta, which is Alphabet and Amazon. But they broaden that out, and if you look at all the companies spending this $380 billion this year, going up to $700 billion, it's those companies plus a bunch of companies on the periphery. You got a Salesforce in there, of course. Oracle's in that category as well. Palantir, obviously a very important stock for a lot and widely held for a lot of investors right now. And when you ask them what stocks they would buy and hold now for the next 10 years, it looks very similar. So very faithful to the stocks that they've owned for a long time, and big believers that this is going to stay that way for a long time. We live in the land of the giants in the stock market. They think that's going to continue for the next decade.
If that's what they've been buying, I'm just curious, what have they been selling?
Yeah, they've been selling, Eli Lilly was a big stock that was on the sales list, and that stock's now at a 52-week high. So sometimes our timing as retail investors is not so good. They're concerned about some of the chip stocks, and some of those chip stocks have had some ups and downs, very volatile sector right now with all the demand and all the deals. But by and large, they buy, hold, and keep their favorite stocks, and I don't think that's going to change.
Keith, as we head into 2026, we're talking all things AI.
Yep.
Investment implications there, are you telling clients, hey, listen, stick with the Mag 7, stick with tech? Where do you want to be overweight?
So we still want to be overweight tech. Something we just looked at recently is each bull market, who is the leader, and does that leadership continue to the end? And what we found out, it historically does. So in the 90s, tech's relative outperformance peaked in March, which is when the market peaked. If you look at the 2000s, which is more of that global industrialization, emerging markets was leadership. It was leadership until the end. And even before, we had the bear market in 2022, technology, rode that to the end. So ultimately, we think if you believe we're still in a bull market, which we do, we think tech ultimately resumes that leadership. But on a short-term basis, just like we're seeing where it gets, semiconductors up 100% off the lows, technology up 60% relative to about 35 for the S&P. It's not going to be a straight line. You're going to get tested. I'd be interested to see the sentiment after the last couple of days. I know other sentiment surveys I looked at this morning, it showed bearishness at the highest level since May. And we haven't had, in the grand scheme of things, a big correction, but we are seeing more of a correction in those technology stocks. So I wouldn't be surprised if sentiment shifts even quicker now, because a lot of people own these stocks.
That's
and they're
right.
seeing them hit.
What do you want to be underweight, Keith?
I think overall, there's still areas like real estate we're kind of mixed on, even though it's a muddle through. I don't know rates are going to move that quickly. We're still underweight staples. I will say it's moving towards an extreme because we are expecting an uptick in the economy. Staples tend to really outperform when you're starting to slow down, so we still want to be there. And then our process is very tactical. We look at relative earnings momentum and relative price along with valuations. We were more negative on healthcare earlier this year. We did upgrade that about a month ago. I know that's becoming like the hot sector all of a sudden, but it underperformed by about 50% over the last 3 years. And now as you get some of that political noise, maybe a little bit behind you and expectations so low, I think there's more room for that to go as well.
Keith, Nela, Caleb, that was great. Thank you all. Appreciate it.
Thank you.
Welcome back to Yahoo Finance Invest. I want to hone in on two of the hottest stocks on the Yahoo Finance platform right now. That's Nvidia and Tesla. And joining us now is resident bull on both names, Wedbush analyst Dan Ives. And Dan, you were supposed to be with me here in studio, but I heard even though the government shutdown is over, you might have had a little plane trouble and you're stuck in Miami down there?
Yeah, stuck in Miami. Actually, it's my second time in Miami in this week. I thought I'd be lucky to get back, but it looks like it's going to have to wait a day.
You're a busy man. We know this. I'm sure it has nothing to do with how cold it is here in New York City, but I have a lot of viewer questions for you. Before I get to that, I do want to ask you your 30-second bull pitch for Tesla and your 30-second bull pitch for Nvidia, because I know you're very, bullish on both of those names.
Yeah, look, on Tesla, this, in my opinion, is the most important chapter ever for Musk and Tesla, the AI chapter. Autonomous and robotics, I think we're talking 2-3 trillion in terms of market cap, best physical AI play besides Nvidia. When it comes to Nvidia, the godfather of AI, there's only one of them, and that's Jensen. And look, demand to supply is 10-1 for Nvidia chips. Get the popcorn out, get the watch parties out for next week's earnings, because this is, in my opinion, is going to be a $6 trillion market cap in 2026. And again, the bears will continue to yell from hibernation caves. They'll be wrong.
All right, they'll be wrong. You heard it here first. But let's get to some of our social questions. And I want to start with Tesla. One social viewer asks, Tesla seems to be a show me story with investors all in on robo-taxis and automation, but that seems years away. How much patience does it take to be a Tesla shareholder?
It takes a lot of patience. And we've talked about it so much, on Yahoo and on the show, because this is when you have to have the understanding of what Musk and Tesla are trying to do here. They're building out the AI future. Autonomous, they're going to own 80% of the autonomous landscape, in my opinion, over the next decade. Robotics, Optimus, that's what you're playing for. It's less about deliveries. It's more about the AI future. You have to be patient, but it goes back to this, in my opinion, is going to be the most important chapter ever in Tesla's story.
All right, another question from our audience here, Dan. You've compared the AI boom to a party before, and that we're still early on in the night. Do you have any new analogies for where we are in the AI trade right now?
Yeah, so look, I mean, it was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m. And it's my view where, look, you're going to have glass on the dance floor, DJ stops playing music, but that party is going to continue to rage on. The Bulls and the Bears meet up at 6 a.m. at the diner. Bulls had a lot better night than the Bears.
But Dan, my mother always told me nothing good happens after midnight. So how do you know when to leave the party?
Look, and that speaks to my view. It's all, like, when it comes to AI, it's all about demand, right? I mean, 3 million air miles the last 25 years. I'm always on the road trying to understand what demand looks like. I was in Asia for a month. Demand's accelerated 30% over the last 4 or 5 months. So look, I get some on the valuation, but when those call an AI bubble, they're underestimating the scale and scope of this AI revolution. And for the first time in 30 years, the US is ahead of China.
All right, I'll tell my mom for the AI party you have to stay all night long. But I do want to take some time to talk about your outfits, Dan. This is something that you are known for. I want you to show the camera what you're rocking today. A lot of patterns, a lot of personality. I mean, what's the inspiration behind your style?
Yeah, I mean, look, I'll show you wearing today, right? I mean, this is
love it.
This is my man. But to some extent, you know, I always have dressed in a way that it's similar to how my stock picking is. It's different, right? But ultimately, it's what I'm comfortable with, you know. And I also, it brings color and fun to an industry where, you know, that maybe historically hasn't been there. And I think that's also why, like, you know, my clothing line, DanIvesClothing.com, we've had, you know, we've sold 400 or 500 shirts out there. And, you know, it's an exciting time. More want to get into the color and just have fun with this.
So would you say your outfit picking is similar to your stock picking?
I would say. I mean, I think to some extent, it's like I don't care what others think. I go to the beat of my own drum, and the reality is that, you know, it's something where I've always dressed different. That was in Korea a few weeks ago. And look, I think it's one where it also gives inspiration to others, where it's like going out of the box, but it's similar to how I pick my stocks, right? If you just looked at valuation, I always say the bears, when they're in hibernation mode, they can't see AI in the spreadsheets.
Now, I was doing some digging and I saw you have a collaboration with this fashion brand, Snow Milk. And the shirts ain't cheap here, Dan. You have $100 for a polo. I mean, these shirts are trading like some of these AI stocks. Is the valuation justified here?
Look, I mean, those are made in the USA, made in Williamsburg, Brooklyn, right? I mean, and it's one where you look, and this is something where all those shirts are handmade, right? And we'll eventually have sweatshirts and hats, and I could see Sazi wearing one of those sweatshirts soon. But look, this is it's having fun with it, right? And I think also it speaks to my view in that party at 10:30 p.m. You don't want to be wearing the Peter Millar and slacks in that party on the dance floor.
All right, well, I'll be patiently waiting for you to send me my own shirt here, Dan, but thank you so much.
Welcome to Yahoo Finance Invest. The global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. In the backdrop, record-setting markets that are sparking fears of a correction or even worse. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, a real treat to have you here at Invest. Thank you for always making time for us. Let's start out of the block here on cockroaches. There's a lot of talk on Wall Street right now on cockroaches, and this essentially is risks coming out of various places, and it's hard to stop them. What say you? Where's the next, I guess, economic cockroach to be found?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued. But we're not seeing it, I guess this goes to your point, we're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The One Big Beautiful Bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. Like, how do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived. And the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohamed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate endgame for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all 5 realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the 5 candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Rieder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You could see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's three elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Always a treat to get some time with you. I always enjoy our conversations. Mohamed El-Erian, Allianz Chief Economic Advisor. We'll talk to you soon. Thanks for joining us here at Invest. We appreciate it.
Thank you.
Our next guest's career in financial services has spanned 4 decades, and she's appeared regularly on lists like Barron's Most Influential Women in U.S. Finance. I'm joined at Invest by Ann Walsh, Managing Partner of Guggenheim Partners and the Chief Investment Officer of Guggenheim Partners Investment Management, which oversees more than $350 billion in assets. Ann, thanks for being here.
It's really nice to be here.
So it has been a really interesting market environment. I guess maybe we live in interesting times, as the proverb goes. And I know one of the more recent things that we've been watching in the market here has been the government shutdown and now the end of the government shutdown. And it was interesting because the shutdown happening didn't really seem to harm the rally in the equity markets. But there did seem to be a little relief when it was over. I mean, how did you think about the shutdown? And more broadly, how do you think about government functionality as it relates to investing?
So we've certainly seen now a record-setting government shutdown, but we saw the second longest during the Trump 1.0 administration. And I think this fiscal policy and political disruption is really one for the playbooks for the rest of the Trump administration. And the volatility ride, I think, will continue from that perspective. Having said that, I think that we are through some portion of some of the volatility that we saw earlier in the year. I like to think of the Trump administration of having 4 policy pillars in no particular order. Trade and tariffs, which continues. Deregulation, which is sort of going on in the background right now with great pomp and circumstance to begin with DOGE, but really kind of now playing around in the background. Tax policy, which is one of the elements that's actually got some certainty to it now because of the One Big Beautiful Bill passage, and I think that's going to create some tailwinds into 2026. And then ultimately the immigration policy, or if I tend to prefer to call it reverse immigration. So we're seeing all of this play out, and I think that's going to continue.
Do you think that it is all of this is at this point an underappreciated risk by the market? The market seems to have gotten somewhat used to some of this. And again, more broadly, do you think that the political gulf in this country is an underappreciated risk by the market?
Well, I think we have to sort of separate markets from politics and policy, and obviously, and even the real economy. They have combined effect, but they're operating in almost a siloed fashion. The disparity or the discourse with regard to policy and politics, that's going to continue, and that's going to create headline volatility. But I think the market's looking through that, whether you're talking about fixed income markets or you're looking at equity markets in particular. You're looking at Fed policy. Markets are considering a whole lot more factors, and they're looking at the fundamentals separate from the narrative that we see at the headline level.
All right, so let's talk about some of those fundamentals then, and let's start with the Federal Reserve. Now, earlier today, we here at Yahoo Finance Invest heard from the former Fed Vice Chair Lael Brainard, and she talked about the challenge that is right now before the Fed. So I want you to listen to what she had to say, and then we'll talk about it.
With inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, a very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that.
And it's interesting because at the same time, she said she would vote in favor of a cut in December because she is more worried about the labor market. What do you think is going to happen here with rates?
So we're at kind of a delicate time because we have had the government shutdown. We don't have the usual data sources for the Fed to point to, and they like to claim to be data dependent. Having said so, they also look very much at anecdotal evidence, and in particular the Fed's Beige Book, which seems to indicate a slowing down of the economy to a level that I consider more equilibrium. And if we're in more of an equilibrium, which is a sub 2% real rate of growth, then I'm looking at real rates of interest that should be lower. The neutral rate should be lower. And so let's just assume the neutral rate's a 3% level. So for the Fed to continue to cut rates to 3%, they have some more cutting to do. I'm in the camp that I believe that they actually will cut in December because I look at that Fed Beige Book and it seems to indicate a lot more slowing and fraying around the edges in particular. One area that we've watched all year long and will continue to watch is sort of what I call the bifurcated economy. Right. There's really 2 speeds that are happening in the U.S. economy. One is the lower end consumer, and the small business market, and the other is the high-end consumer and the larger companies with access to capital and the ability to, particularly benefit from the AI trade, for example. And so as a result, we've had this two-speed economy, and the Beige Book really represents this broader level of the economy, and it's really becoming much more sluggish. And so as a result, I think ultimately the Fed will say neutral's probably lower than it is now, probably closer to 3%. And, the idea of actually cutting rates makes sense. And I still also contend that we're going to see more rate cutting in 2026 as well.
And you think that the sluggishness in the economy will take care of the inflation issue? Because that hasn't gone away.
Right. Well, one of the other elements about this bifurcated economy, of course, is that portions of the economy that are particularly sensitive to interest rates. So the interest-sensitive parts of the economy are also slowing down, housing in particular. And the cost of housing is actually declining, although that's not much reported. The last CPI number, the one that we actually got to see, seemed to finally indicate the owner equivalent rent portion of CPI had finally started to move down. And I think that's going to make a big difference. So while I believe that the rate of disinflation has slowed, the trend is still towards more disinflation, which will then also be supportive of further rate cuts.
I also wanted to ask you about the composition of the Federal Reserve. As we know, and as Lil Brainerd just alluded to, it's a very divided Fed right now. But we're also going to, of course, get a change in leadership at the Fed next year. And the White House's sort of rhetoric about the Fed has faded to some extent. But who do you think is the best choice to lead the FOMC next? And are you concerned about the White House sort of, again, leaning on that person when it comes to policy decisions?
Well, a few ways to look at the selection process. One, I think that the panel of nominees that are being considered are all pretty well qualified to be Fed chair. I have my particular favorites, but
you want to tell us who they are?
Well, I actually happen to be a big fan of Kevin Walsh. And I'm biased because he's a bit more of a monetarist, and I do believe money supply still matters. But Mickey Bowman's amazing, and maybe more of a dark horse is Kevin Hassett, and then I'm a big fan of Chris Waller as well. So we have a good selection of potential candidates, and notice I sort of picked more of the economist background personalities, if you will. Having said so, I believe ultimately it's not the first time we've seen political pressure put on Fed chairs. We go back to Nixon, we go back to Lyndon Johnson. There's a long history of presidents trying to put pressure on the Fed chair. And strong Fed chairs are important. Independence is important, but let's remember the Fed's also subject to congressional oversight, so not fully independent from policy oversight. They have two mandates. The dual mandate of stable employment and stable prices is still part of what they're obligated to work towards and engineer. Having said all of that, no matter what happens, I think we are looking at a more dovish Fed composition, and that means we're back to my concept of and belief in much lower neutral rate going forward, which should be helpful for the interest-sensitive part of the economy, the lower-end consumer to some level. For example, along with, in 2026, some tailwinds that we're going to have, particularly with the One Big Beautiful Bill, there's some tax benefits in there that will also be rather stimulative. So I think all of this keeps us out of any kind of recession risk, but it lends us to more of a neutral policy.
I wanted to come back to the other big driving engine in this economy, and that's AI, of course, which you and I have talked about before. How are you thinking about this whole bubble question and how to strategically invest in AI right now?
So I'm a big fan of technology in the long run, and I believe artificial intelligence will ultimately be a technological game changer. But it has to play out. We're still in early innings. The huge amount of investment that's being undertaken right now is in what, the blocking and tackling, the chips, the infrastructure build out, the data centers, and ultimately the power needed to power all of this into the future. The applications, the work streams, the usage of AI has to broaden out into the entire economy, and that's going to take some time. So in the long run, I'm also very positive. In the short run, in terms of just equity valuations, the question is, are we in a bubble? And I think if you look back to it, the number one comparison time frame, which was the internet bubble in late 1990s, you were looking at valuations that were so extreme because you didn't really have any earnings. Now you have earnings, and I think the risk or the concern is, are we going to now pile on quite a bit of debt to build out the infrastructure for artificial intelligence into the future? And I think that's something to watch, but I don't believe that we're there at this point in time. I think there's more for this market to run, and I think technology will continue to drive a lot of stock market performance.
So on the corporate lending side, you don't yet see, or maybe we won't see, that sort of reach for risk in terms of this build out. What kind of warning signs would you, as someone who is very experienced in the credit markets, what would you be looking for?
So I get asked this question a lot, particularly with regard to private credit, which is, where are we in the cycle? And what I say is there's cyclical risk, and then there's structural. And cyclical risk is what happens late cycle in the economy, when the economy slows down, there's more bankruptcies due to businesses failing, usually recessionary pressures. We're late cycle, but we're not really there in a recessionary environment. Structural happens when you end up with over leverage, too much lending to over-levered entities.
Like the financial crisis.
Exactly. And you also end up with weakened covenants, investor protections go away. And when you get a few headlines like, Tricolor, for example, or First Brands, you get people questioning, are we having structural risk, or is this still cyclical? And I would say it's still more a little bit cyclical, as those particular companies tend to start to have problems late cycle. So, but we don't have what I consider to be at this point in time a structural, widespread risk, and I'll say yet. But that's what I look for and what I'll look for in the future.
And you have a great analogy to explain at these cyclical times when people reach more for risk. You have an analogy that explains sort of the risk that maybe they're taking in offering some of these loans.
Well, I think actually what ends up happening is people don't examine where the collateral is, what the underlying value is. And my analogy, it's a little rough, but you can take a Tiffany's box, and it's beautiful and it's gorgeous and they put a pretty bow on it, but if you fill it with dirt, there's no diamond ring inside. It's just a box with dirt in it. And I think that's what lenders and investors have to be aware of, is know what you're investing in. And do more than just look at the outside and assume that everything is okay. Really do the diligence. Select your asset manager carefully, and that you know that they're doing their diligence.
Right. Do the work. That's always good. That's always good advice. I want to end on this, Ann. Obviously, you work really hard. Every time I see you, you're traveling around, speaking to investors, working with portfolios. What do you do when you're not doing this? What do you do to relax?
Well, I read a lot, and actually, I do get to play some golf. So I get to spend time with my family, and we're all golfers, and it's a good way to come together and enjoy a beautiful afternoon. So yes, there actually is from time to time some downtime.
I like it. All right, good. Thank you so much, Ann. Great to see you.
Thank you, Julie. Nice to see you.